Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock, with news official rescue efforts haven't allayed deep fears about the immediate economic situation. Friday's 9% equity market bounce on Wall Street has been undone today, revealed for what it was, wishful thinking, with the S&P 500 currently down 9% so far and falling. The US Fed's rescue package, one called for and applauded by the US administration, has had the opposite effect of shoring up confidence. It in fact undermined investor confidence. Markets are watching the cumulative impact of consumer and business decisions, none of which are positive, as fear pervades all decisions. A remarkable thing about the weekend Fed move is that they fired as many bullets in one weekend day as they did in the whole of 2008. With sudden financial largesse like this, there are sure to be huge and unexpected distortions flowing around the world. We are in a monetary black hole. Wall Street is following Europe and adding to the decline. European markets were down about 5% overnight, and yesterday key Asian markets were down about 3%. In the US, we are seeing the first of the regional factory surveys diving. The New York survey reported sharply lower levels, similar to those last seen in the GFC. The collapse of new orders is a big new worry. And getting goods to market is now going to be a major problem for firms that have orders. The unprecedented shrinkage of passenger travel and by air has removed vast amounts of air cargo capacity. Approaching 200,000 flights have been cancelled in the past 6 weeks, and the remaining capacity is focused on urgent medical supplies. Given there are about 100,000 flights per day globally, and that the reduction has been sudden and concentrated in the last 2 weeks, and growing, the situation will get very tough very quickly. Will the rest of the world be saved by China's re-emergence from the other side of the virus emergency? It will have some impact, but nowhere near enough to save the US or Europe. But it might be an ameliorating factor for Japan and important for New Zealand. China's February industrial production was down 13.5% year on year compared with the usual rise of more than 6%. China's retail sales were down more than 20% on the same basis, a shift from an 8% rise. These are enormous changes striking at the heart of the Chinese economy. It is unlikely that this data will be any better in March. But as big as these falls are, they still have their economy ticking over. Things did not come to a complete stop. The thing about these sharp drops, they're the sorts of changes the rest of the world is looking at in March and April. It's going to get much more ugly than most in the West are assuming. Monetary policy won't be able to save us from that. US Treasury 10-year yield is falling today, down almost 20 basis points from yesterday and resuming its downward track. It's now at 0.72%. And gold keeps falling. It's down $27 an ounce today to $1,503 an ounce. It no longer operates as a price hedge against uncertainty. And US oil prices have dropped sharply today as well, down another $3 a barrel to under $29 a barrel, with the Brent benchmark under $30 a barrel. Vanishing demand is accentuating the Saudi-Russian fight, and they seem to have lost control of it. And the Kiwi dollar is starting today with a bounce higher. It's now at 61 US cents. On the cross rates, however, we've leapt against the Aussie dollar, which is still getting marked down hard. We are now at 99.4 Australian dollars, a rise of almost 1 cent in a day. And at that level, we are just a whisker off an all-time modern high and very near parity. For Kiwi sellers of Australian dollars, we're well past parity. Against the euro, we're little changed at 54.7 euro cents. That means our trade-weighted index is now at 67.2, winding back some of the 2020 overall devaluation. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.